In this free video course, I'm going to show you everything you need to know about chart patterns for trading stocks, cryptocurrencies, forex, or any other financial market. And my goal is ambitious, but I want to make this the best chart patterns course on YouTube. I will not only teach the basics, I will also talk about things that other YouTubers don't share or hide behind paywalls. Alright, so first of all, who is this course for? This course is for you if you are either a beginner or if you are a more experienced trader. I have built this course in such a manner that even if you are completely new to trading and chart patterns, you will be able to follow along step by step. But also, this course will be long and comprehensive, so even if you are a more experienced trader, I'm sure you will learn a lot, such as more advanced trading strategies and more advanced techniques. And as I mentioned in the intro, it doesn't matter if you trade stocks, forex, crypto, or any other market. Chart patterns are universal, meaning that they appear in all markets. And the chart patterns also appears on all time frames. So it doesn't matter if you are a day trader, if you are scalping, or if you are swing trading. This course is for all types of trading. However, some patterns work a little bit better in the short term, while some patterns are more suitable for the long term. But don't worry, we will talk all about that. And this course is for you that want to be consistently profitable. And in order to be consistently profitable, you need to be ready to dedicate time and effort. You need to dedicate time, like for example, watching this course, but you also need to dedicate effort. So it's not enough to just watch this video, you also need to practice what you learn in real markets. So now, what can you expect to learn from this course? Well, first of all, you will learn how to identify chart patterns, and you will also learn chart pattern classifications. Every single chart pattern has both a direction and a type, and we will talk all about that and why it's so important. But here, and this is very key, we will cover both the logic and psychology behind these chart patterns. Many videos out there will teach you how to identify chart patterns, but it is at least as important to understand the why. So for example, why does a certain chart pattern lead to the price going up, and why does a certain chart pattern lead to the price going down? If we can understand the why, we can use our chart patterns in a broader context. And this is how you really will become a better trader. And during this course, we will of course talk about the advantages of chart patterns. Chart patterns can be amazing, but what's very important, we also have to talk about the limitations of chart patterns. For example, during this video, I will share with you guys some chart patterns that many traders say work well, but they can actually be traps leading to losses, especially for beginner traders. So make sure to, pay extra attention to these patterns. So now I want to share some important sort of tips and tricks that you can use during the course to learn and improve much faster. And the first tip here is that if you are a beginner, I recommend to watch the chapters in order. As I already mentioned, I have built this course in a step-by-step manner. So if you are a beginner, I really recommend that you watch the chapters in order. And for more advanced traders, perhaps you have been trading for a while, you have a basic understanding of chart patterns and so on, I would actually still recommend that you watch the chapters in order, just because the course is in a step-by-step manner. But what you can also do if you are a more advanced traders is to use the timestamps or the video chapters. So you can skip over certain parts or perhaps replay certain parts and so on. My next tip here is to take notes, either if you have a pen and paper available, or you can do it digitally on your computer, phone, or whatever. But it has been proving that taking notes will enhance your understanding and improve the retention of what you learn. So this is something I definitely recommend. And one thing that I personally really like about, educational videos, for example, when I studied math, I pretty much learned everything by watching educational videos on YouTube. And one of the main benefits of educational videos is that you can replay parts that are uncertain or unclear until you really get it. And the next tip here is to do the exercises. So during this course, I will give you guys some exercises, because in order to become a better trader, you need to not only learn, you also of course need to practice. So if you want to take trading seriously, I recommend doing the exercises. It's of course nothing you have to do, but I do recommend it. And last but not least, guys, ask questions. If anything during this course is unclear, make sure to drop a comment down below. I will try my very best to answer every single question on this video. Alright, so let's begin here by talking about how to classify the chart patterns. Every single chart pattern has both a direction and a type. So throughout this course, we will give every single chart pattern both a direction and a type. So let's take a look at both of these classifications individually. The direction specifies how the price will move after the chart pattern has appeared. And we have two different directions. A chart pattern can be either bullish, which indicates that the price will go up after the chart pattern. The other direction is bearish and indicates that the price will go down after the chart pattern has appeared. Not every single bullish chart pattern will lead to the price going up, and not every single bearish chart pattern will lead to the price going down. But if we can learn both how to identify and how to trade these patterns correctly, this will be true most of the time. The other classification is the type. And the type specifies the price direction after compared to the price direction before. And once again, here we have two main types. The first one is the reversal, and the second type is the continuation. And we have two different types of reversals. The first reversal is the bullish reversal. And for the bullish reversal, before the pattern appears, we have the price going down. Then the pattern appears. So this circle right here is the chart pattern. And then after the pattern, the price goes up. The other type of reversal is the bearish reversal. And this is the opposite of the bullish one. So before the chart pattern appears, we see the price going up, the pattern appears, and then after the pattern, the price is going down. But we also have two different types of continuation patterns. The first continuation pattern is the bullish continuation, and this means that before the pattern appears, the price is going up, then the chart pattern appears, but after the pattern, the price will continue to go up. That is why it's called continuation pattern. And of course, the opposite is true for the bearish continuation. For this one, the price goes down before the pattern appears, then the pattern appears, and after the pattern, the price continues to go down. But we also have one more type. This right here is the type that I call uncertain, and these patterns are very important to be able to identify, because these patterns will not have a clear direction, and many times they will also not have a clear type. So these patterns can be super hard to trade, and most of the times these are patterns that I try to avoid. And now you may wonder, why do I even include uncertain patterns in this course? Well, when it comes to trading, it's of course important to be able to spot trading opportunities, but it's actually also important to be able to spot when not to trade. So I would highly recommend that you don't skip over the parts where we talk about uncertain patterns. So yeah, as I just said, these are chart patterns that I avoid at all costs. So let's put what we learned here together and take a look at some chart pattern classification examples here. So remember, every chart pattern has a direction and a type. So an example of a chart pattern could be, for example, a bullish reversal pattern. So this is where the price goes down, we have the pattern, and then the price goes up. Another example could be a bearish continuation pattern. This would be the price going down, the pattern appears, and then the price continues to go down. Yet another example could be a bearish reversal. In this case, we have the price going up before the pattern, then the pattern appears, and then the price goes down. So now guys, we are finally ready to start exploring the chart patterns. And for every single chart pattern, we will both take a look at how to identify the pattern and how the pattern would look like in a textbook. But what we will also do for every single pattern is to take a look at real life examples and strategies. So we will both take a look at how to find the pattern, but even more importantly, we will also take a look at how to trade the pattern. All right, so I think a great pattern to start off with is the double bottom pattern. This right here is a bullish reversal pattern, which means that the price is going down before the pattern appears. And the goal with this pattern is to reverse the price to the upside. So to identify the double bottom, you first need to identify a downtrend. This is when we are printing both lower highs and also lower lows. After the move towards the downside, what you're looking out for here is two lows which are at around the same level. These two lows doesn't have to be on the exact same level, but they should be roughly at the same price. What we usually do here is that we drag a horizontal line between the two lows. And we also want to draw a horizontal line connecting the high here in between the two low points. This move right here, the first move down after the pattern has appeared, is also significant. So now let's take a look at how do we trade this pattern. Well, first of all, you can see that this is a double bottom because we had a move towards the downside. We saw one and two lows at the same level, and then a reversal towards the upside. The most common entry point is to enter on the candle that breaks above the line defined by the high in between these two low points. However, I actually have another entry point that I personally prefer many times, but first take a look at the strategy for entering the breakout. So your entry would be where this candlestick close, so at the high of the close right here. If you enter at that point, the most common place to set your stop loss is to set it just below the lowest point of the double bottom. And if you don't know, the stop loss is where you will automatically sell if the price goes down to this point. As for your target level, what I usually recommend here is to target a risk to reward ratio of 1 to 2 or more. And what I mean with this is that the distance from your entry point to your target should be more than twice as long as your distance down here to your stop loss, which would make your profit target around here. So that is one simple strategy. However, another strategy that I personally really like is to enter at the candle that just slightly dips below the low created by the first bounce. What you can then do is that you can enter on the candle close of that move. And one thing to notice is that you will not always see the price dip below the line created by this point. Many times the price will reverse just slightly above, and then this is not as good of a strategy. But when the price wicks below this line right here, I personally like this type of entry. For this type of entry, I would also place my stop loss just below the lowest point of that candle. And using a risk to reward ratio of 2, perhaps our profit target would be here. So this right here is a much quicker strategy. Our goal here is to get in and out quickly and make some quick profits. Another potential entry is that many times after the price breaks this point right here, the price will pull back. So another entry point is to enter on that pullback. However, in this example, the price broke this level and never looked back. But many times you will see a pullback, and that can also be a great entry point. I will talk about that entry very soon when we talk about the double top strategy. And you may wonder, what is the psychology behind the double bottom? Well, it's pretty simple, because before the pattern appeared, we had a downtrend. And when we see a low, another low, and then when we break this high right here, the downtrend is terminated, and that is where the buying opportunity comes from. So now guys, we are ready to take a look at the double top pattern. And later when we take a look at the double top strategy, we will look at the entry type I talked about earlier in the course. But first, let's take a look at how we identify the double top. So as always, the first thing we want to do is that we want to take a look at the direction and the type. So in this case, we have a bearish reversal. So before the pattern appears, we want to see the price going up. Then this red part right here is the actual pattern. And after the pattern, we want to see the price going down. And compared to the double bottom, I made this example a bit more messy, and that is because in real markets, you will seldom have, you know, perfect looking patterns. Most of the times the patterns will look more something like this, a little bit more messy. But the same principle here applies. So for the double top, the price is pushing higher, but then at one point, we find two tops here at the around same level, indicating that the price is struggling to push higher. What we usually do here is to drag a line here in between the two highs. And what I want to show you guys with this example is that sometimes the price will push quickly above the high before the reversal. And what you also can see here is that in real markets, we will sometimes have sort of multiple minor lows in between the highs. So it's important that you drag your other horizontal line at the lowest low in between the highs here. So now let's take a look at this pattern in action in a real market. So you can see in this example, we had the price pushing up, we got rejected one time, and then we got rejected one time again. This was actually almost like a triple top, so we almost had 3 small reactions here. And when we talked about the double bottom, we already mentioned this type of entry when you can enter at the resistance. We also talked about the entry where you can enter at the break below the line. So for this pattern, I want to focus on this type of entry right here. And this one can be a little bit tricky to understand, especially for beginners. But essentially what we're looking out for here is that, first of all, this strong bearish candle right here broke below the low. So this right here is a common point to enter. But an excellent entry point can actually be to wait for the price to pull back, or in other words, move against the direction of the breakout move and then enter at the pullback. So in this case, the entry would be right here. And to make this example more clear, let me actually show you guys how this would look like in a textbook. So in a textbook, let's say we have a clear, very super clear double top like this. And in a textbook, the pattern will usually look like this, right? You will see the price going up to the exact same point and test the previous support as resistance. But you can see that in real markets, many times, like it did right here, it actually pushed above this middle line. And this is super common, and this is why you should not be too focused on these sort of perfect patterns that you see in textbooks. It's fine to see the price pushing above this middle line, but what we want to see in order to confirm the entry is a small move here towards the downside. So entry right here. You may of course wonder, where do we place our stop loss? Well, for this type of entry point, I think the stop loss is very clear. Usually you will set the stop above the highest point of the pullback. So in other words, you want to set the stop loss above this point right here. And if you target a 2-to-1 risk to reward ratio, your target would be somewhere around here. And for the double top, you can also use the strategies we talked about earlier in the course when we talked about the double bottom. So now guys, the time has come for the bull flag pattern. The bull flag is one of my personal favorites. I really like this pattern, both because it happens so often in the market, it appears all the time, and it's also a relatively simple pattern. To identify a good bull flag, what you are looking out for is that you want to see a strong impulsive move. So the move that goes in the same direction as the trend are called impulsive moves. And then we want to identify a pullback. And a pullback is essentially a move that goes in the opposite direction of the trend. Many times the bull flag will print sort of minor lower highs and lower lows within the move. However, bull flags can also be more simple. So for example, this move right here could be a bull flag, and this move down here could also be a bull flag. The difference between a good and a bad bull flag is often more about how the price behaves, both during the move towards the upside, but also inside the actual flag. So let's now take a look at the bull flag strategy and how to trade a bull flag step by step. So first of all, you can see that the flag we have right here is the one most similar to the sort of textbook bull flag we just recently took a look at. Because as you can see, we had this impulsive move up, then the price started to move against the direction of the trend and also inside the actual bull flag, we printed both lower highs and we also printed lower lows. So this is a very classic example of a bull flag. And in order to find a good bull flag, what you're looking out for is that you want the move that happens before the bull flag, so this move right here, you want this move to be pretty sharp. It's a good sign when we see strong candles like this one and this one happening before the flag. During the actual flag, what we preferably want to see is that we want to see lots of these candles that are pretty small, like these three right here, these three right here. In simple terms, we usually want the flag to be pretty tight here, and we don't want the price to move too much. The most common way to enter the bull flag is to enter on the candle that breaks the flag. So you can see that this right here is the candle that broke above the flag, and what we usually do is that we enter on that candle close. And preferably what you want to see with the candle that breaks above is that you want to see a strong candle. Just as the candles we talked about down here, it's a good sign when we see a long and strong candle. As for your stop loss, you usually place it below the lowest point of the flag. And in this case, you can actually see that the lowest point is all the way down here. In this case, we had pretty much one low and two lows at the same level. So we want to make sure to place the stop a tiny bit below. The reason why we do this is because if the price gets rejected at the resistance of the bull flag, we can actually allow the price to get one more bounce on this support without getting stopped out. To keep it simple, you can use a risk to reward ratio of 2, and we have been talking about what that is earlier, so your target would be somewhere up here. However, another method you can use is to measure the impulsive move up, and you can take this exact measurement from the lowest point of the bull flag and make this point right here your target. Another way to enter the bull flag is to try to enter at the support of the flag. But in order for this entry to work, so imagine that this right here is the flag. What I usually want to see is that I want to see a candle that looks something like this, that quickly dips below the support of the flag and then quickly pushes above. If we see a candle like this in the bull flag, then a good entry point is to actually enter at the candle close of that pattern. You might recognize this type of entry from the patterns we talked about earlier in the course, and I'm personally a big fan of this type of entry. And this type of entry is often called a false breakout or a failure test. What I also want to show you guys with this example is that not all bull flags will look like this. Not all bull flags will have highs and lows like we see in the textbooks, but many times they will be just simple pullbacks. So for example, if you take a look at the flag down here, you can see that it's pretty much a line. We have an impulsive move, we have a move against the direction of the trend, and here we saw the breakout. However, now I have a short exercise for you guys. I want you guys to think about which of these bull flags are the best. And I want you guys to specifically think about the move that happened before the flag appeared. So if you want to, pause the video right now, think a bit, and drop your answer down in the comments below. Hey, why aren't you pausing the video? Just kidding, you of course don't have to do the exercises here, but I do think it's really valuable to sometimes pause the video and think. So the answer here, at least for me, is that this right here is a better bull flag. And this is not because the bull flag looks more like it does in the textbook. The reason I think that this bull flag is better is simply because the move that happened before the flag appeared was much stronger. And this is what we want to see. If you compare it to the move that happened before this flag, you can see that during this upwards movement, we had lots of small candles and we had sort of low momentum, and preferably before the flag, we want to see strong momentum. So now guys, let's take a look at the bear flag pattern. As you can hear on the name, the bear flag is a bearish pattern and the type is continuation. So before the pattern, we have a downtrend, and the goal of the pattern is to continue the downtrend. For the bear flag, the price will be sloping upwards during the flag, and we usually define the flag using two lines like this. In textbooks, you will usually find the pattern printing higher highs, sort of minor higher highs, and higher lows within the pattern. But as I talked about with the bull flag, this part right here in some situations can also act as a flag. So a bear flag doesn't really have to print higher highs and higher lows within the flag. Sometimes it will be more like a straight line. So let's now take a look at the bearish flag in a real market and the bear flag strategy. So first of all, as you can see here, we have a very nice downtrend. We are printing lower highs and lower lows. And this right here is a great example of a bearish flag. But what you can notice about this flag is that in this case, we don't really have super clear highs and lows. You can see, yes, we do have some highs and lows within the flag, but it's not really the super clear flag you see in textbooks. The most clear entry point for the bear flag is to enter here at the breakout, or some traders, when we break down, will call it a breakdown. And when you enter the breakdown, you want to enter at the candle close. However, when we see the candle close happening near the support level of the flag, many traders will wait for one more candle to confirm the breakout. This right here is what we call a confirmation candle. So another entry point would be around here. The stop loss for the bearish flag is pretty straightforward. You want to place the stop loss just above the highest point of the flag. And in this case, it is this point right here. As for the target level, we have two main methods. One method is to measure the impulsive move that happened before the flag. You take the exact same length and measure from the highest point of the flag. So this will give us a target level all the way down here. But what you can also do is to use a risk to reward ratio. And in this case, if you use a risk to reward ratio of 2:1, your target would probably be, outside the image, pretty much all the way down here. And now I have another super short exercise for you guys. And that is simply, can you find another bearish flag on this chart? Pause the video and drop a comment below if you want to. Well, one could definitely argue that we have a sort of very small bear flag right here. And this was actually a pretty decent bear flag because during the impulsive move down, we saw a pretty strong move. We also saw a pretty nice breakout candle. So this bear flag was not too shabby at all. So now it's time for, I would say, one of the most iconic chart patterns, and that is the head and shoulders pattern. The head and shoulders pattern is a bearish reversal pattern. So before the pattern, we have an uptrend, and after the pattern, we have a downtrend. The pattern itself consists of 5 important points. First of all, we have the left shoulder, which is this point right here. We have the head, and we have the right shoulder. The other 2 important points are these 2 low points that happens between the 3 high points. Or we actually have a 6th important point as well, and that is this point right here. And later on, I will talk about why that point is so important. And the reason this is called a head and shoulders pattern is because, as you can see, the pattern kind of looks like the head, the highest point in the head, and then we have the left shoulder and the right shoulder. And the pattern doesn't have to be straight like this. It can sometimes slope a bit to the right, slope a bit to the left. But the important point here is that we have a high, then we have a higher high, and then we have a lower high. What you also want to do for the head and shoulders pattern is that you want to connect the 2 low points in between the highs. So we want to draw a line in between this point and this point. And another tip for you guys is that this pattern becomes stronger if this low point right here is actually lower than this low point right here. And this is from a market structure perspective. After watching this course, I highly recommend that you guys check out my course on market structure. I will make sure to leave the link to that video up in the corner of this video. And the reason for this is that if this point right here is lower compared to the previous low, then you can see that we have both lower lows and at the same time we have lower highs. So in this case, after this high right here, we actually have the beginning of a downtrend, because in order to have a downtrend, we need to have lower highs and lower lows. That is the beginning of a downtrend. So having this point a little bit lower than the previous point makes this pattern a little bit more likely to succeed. So now let's take a look at the head and shoulders strategy and take a look at a real market example. So the first thing we of course need to do is to identify the pattern. In this case, you can see that we have one high, then we have a higher high, and then we have a lower high. And what you also can see here is that the lows in between the highs are sloping downwards. And as I said, that makes the pattern stronger. As for the entry points, we have two main ways to enter. The first entry point is this point right here. You can see when the price breaks below the downward sloping line. By the way, this line right here is what we call the neckline. If you use this entry point, the most common place to set your stop loss is to set it just above the right shoulder of the pattern. So you set it just above this point right here. And if you're using a 2-to-1 risk reward, your profit target would be all the way down here. So it is important to notice here that compared to the previous patterns we have been talking about, the head and shoulders pattern is a very large pattern. So it will take a long time to play out and you will need patience trading head and shoulders. Another way to take targets for this pattern is to measure from the head down to the neckline. And then you take this exact measurement and measure from the breakout. The benefit using this approach is that your target level can many times be a bit tighter, but depending on how the pattern look like, sometimes when we do this kind of measured move, the target level will actually be further away compared to a 2-to-1 risk to reward. So this will depend on a case-by-case basis. Another common entry is to wait for the neckline to flip to become resistance and then enter at a reaction from the resistance. This entry point is often more suitable for short-term traders because you will be able to have a much tighter stop loss, and because you have a tighter stop loss, you will be able to have a tighter target as well. So in this particular example, you could enter here at the reaction from the resistance. So you can see we're looking at this reaction right here. We have two candles strongly reacting from the resistance. Using this entry point, I would set my stop loss above the highest point of the reaction. So as you can see, I would set my stop loss above this candlestick wick right here. And because the head and shoulders is such a large pattern, what I like to do here is to leave a little bit of wiggle room. Sometimes you can actually, let me change color here. You can actually set the stop loss even higher here to allow for the price some more room to move here. But as you can notice, when we have a tighter stop loss, we will also be able to use a tighter target. So using this type of entry, your target level could have been somewhere around here if you're using a 2-to-1 risk to reward. And as you can see, this would make the pattern play out much faster. And now it's time for the opposite of the head and shoulder, and this is the inverse head and shoulder pattern. And this right here is a bullish reversal pattern. So if you're a trader that prefer trading patterns that lead to the price going up, this pattern is more suitable for you. And since this is a reversal pattern, before the pattern appeared, we need to have a downtrend, then the pattern, and then the price goes up. Once again, the inverse head and shoulders consist of 5 or even 6 important points depending on how you see it. First of all, we have this point. This is the left shoulder. We have the head and we have the right shoulder. These 3 points are important, but we also have the points in between these highs. So these 2 points right here, also important. And the 6th important point is this point right here. This is the first pullback that happens after the pattern appeared. And compared to the normal head and shoulders, I made this pattern more similar to how you will find the pattern if you look at textbooks or Google or whatever. You can see I made the highs here appearing at the same level, and I also made the pullback here going down to that exact level. But it is important to remember that this doesn't have to be the case. The pattern can look more something like this, or even, perhaps more something like this. This right here is more of a, perfect example. And when you have been trading for a while, you will realize that it's not very common that we see these, picture perfect patterns. So here is a very realistic example of the inverse head and shoulders. As you can see in this case, the left shoulder, the head here, and the right shoulder are at, you know, a pretty similar level, but you can still clearly see that we have one low, a lower low, and then a higher low. And in this case, you can also notice that we have one high right here and then a lower high. Just as with the normal head and shoulders, you can buy this pattern on the breakout, so when the price breaks above the neckline. But in this case, I actually want to focus more on the retest. So you can see here, we actually had a beautiful retest of the downward sloping neckline. And one reason that made this such a good retest was that we saw really strong momentum, bullish momentum, coming from the test of the supports. So one way to enter this pattern would be to enter at the candle close of that momentum candle. This is a pretty good entry point for multiple reasons. First of all, we will be able to find a pretty good stop loss level for this case. Because first of all, we have one low right here, the lowest point of the retest. But in this particular case, you can also see that we found a minor low here before the breakout. So because of these two lows, you may wonder, where should we set our stop loss? In this case, I would actually set my stop loss below both of these points. And the logic here is that if the price start to fall after this momentum candle right here, we still have two potential levels where the price can bounce before we reach our stop loss. And using a 2-to-1 risk to reward ratio, your target might have been up around here. But of course, guys, you can also trade the breakout, so you can trade this candle right here. But one thing you have to notice about this particular example is that yes, the price broke above and this candle started off pretty good. But during the candle, the bears took control and actually closed the candle all the way down here. And when you enter on breakouts, you don't want to see, you know, the price go up and then quickly dip below, because this can many times lead to the price going down. And as you can see, after this breakout, we actually saw the price moving slightly down here. And that is why in this case, I actually think that the retest entry, so this entry right here, was the better choice. And this is a very important lesson. Not all chart patterns should be treated equal. Depending on how the price moves at important price points, so for example, how the price moves during the breakout, we as traders need to be able to adapt to how the price moves and not blindly trade all patterns. Alright, so next up we have the falling wedge pattern. And this is actually a special type of pattern. Why? Well, as you can see, this pattern can act both as a reversal but also as a continuation pattern. And the direction here is bullish. So the pattern can appear after a downtrend and reverse the price to the upside, but the pattern can also appear after an uptrend and continue the price towards the upside. To identify the falling wedge, what you're looking out for here is that you want to see both lower highs and you also want to see lower lows. But the slope here of the highs should be steeper compared to the slope here of the lows. So the pattern here will get tighter and tighter. And this is true for both the reversal, but also true for the continuation pattern. So now let's take a look at the falling wedge strategy. And later on in this video, I will also show you guys the reversal version. But for now, let's focus on the continuation version. So as you can see in this example, we had a nice movement towards the upside, and then the price started to print both lower highs, but also lower lows. But what you can see on this pattern is that the upper line is more steep compared to the lower line, and this is exactly what we're looking out for. The most common entry for this pattern is when the price breaks above the upper line. And what we want to see on this entry candle is that we want to see a strong momentum candle. And this right here is pretty much a perfect example. As you can see, the candle where the price broke out is much longer, especially the real body. So especially the sort of wide part of the candle is much larger compared to the candles here inside the wedge. And this is what we want to see. So the entry point here, the most common one, is to enter at the candle close of the breakout. So you enter right there. The stop loss is usually set below the lowest part of the wedge. Or in other words, you set it below this part right here. You can see the price wicked a bit below the lower line. And as for your target level, you have two main methods. One of the methods we have talked about before, and that is to use the measured move. So you measure the impulsive move like we did right here, and you take this measurement and you measure from the lowest part of the wedge. And using this method, your target would be up here. But as with most patterns, you can also use a risk to reward ratio, and our rule of thumb here is to use a risk to reward ratio of 2, so twice as large as the part between the stop loss and the entry. And this would make your target level somewhere up here, pretty much outside this example, outside the picture, but a bit higher compared to the measured move. However, guys, we do have another entry as well. And as you know from the previous patterns, one entry point that I like for most patterns is to enter here at the support. So you could also enter on this candle right here. But for the falling wedge pattern, for this pattern specifically, I personally actually prefer to enter here on the breakout, but some traders find success entering on the test of the support. And what you preferably want to see if you use this type of entry is once again that you want to see the price sort of just slightly dip below the support and then quickly push above. You can see in this example, we actually had a specific type of candle. This right here is a bullish hammer. And when you see a bullish hammer dipping just slightly below support and then pushing above, this can be a good entry. So for this entry point, you would enter right here at the candle close of the hammer. Your stop loss, once again, it will be the same as the other strategy. You set your stop loss below the hammer. But one good thing about this entry point is that you enter before the breakout, and this can allow you to take quick profits. So for example, using a risk to reward ratio of 2, your target level would be right here. And as you can see in this example, you would have gotten some really quick profits because the first candle after the candle you entered already hit your profit target. So now guys, let's take a look at the opposite pattern. This right here is the rising wedge, and for the rising wedge I will also show you the reversal strategy. But first, let's take a quick look at this pattern. Once again, this is a special pattern because the rising wedge can also act both as a reversal and also act as a continuation. So the pattern can appear after an uptrend and reverse the price, but it can also appear after a downtrend and continue the price down. Once again, what we're looking out for here is consecutive higher highs, but we're also looking out for higher lows. So once again here, higher highs and higher lows. That said, for the rising wedge, we want the upper line to be less steep compared to the lower line. So we want the pattern to rise here, but when it's rising, it should get tighter and tighter. So when, once again, the lower line is more steep than the upper line, and this will make the pattern sort of get tighter and tighter and tighter. And when the pattern is very tight, that is often where we see the strong breakout. So now let's take a look at the rising wedge strategy. And here you can actually see that the example I talked about when we talked about the falling wedge is right here. So you can see we saw the falling wedge here, the price continued up, but then after a while we saw a sort of massive rising wedge. And what I want to show you guys with this example is that chart patterns, as you know, they are universal, so they can appear on all types of time frames, but chart patterns can also be very different sizes. So you can see that this massive rising wedge right here is much larger than the falling wedge. And one principle you can notice here, and that you can write down if you are, taking notes and so on, is that continuation patterns are often, you will notice that they will often be smaller compared to the reversal patterns. Reversal patterns can in general be, large patterns. If you remember the head and shoulders pattern and the inverse head and shoulders, these are very large patterns. But when it comes to continuation patterns, they will often be pretty small, like the falling wedge. And if you remember, the flag patterns are also often pretty small patterns. But for now, let's focus on the rising wedge here. So the first thing you can notice is that the price is printing both higher highs and we are also printing higher lows, but the range here of the pattern is getting tighter and tighter. And for the rising wedge, the most common entry is also to enter at the breakout. So you can see that this strong red candle broke the pattern. So our entry point in this case would be to enter at the candle close of this candle, right? But for this case, the stop loss is a little bit more tricky. One way to place your stop loss is to place it just above the high here, pretty similar to the falling wedge we talked about recently. But as you can see, in this case, we also have a wick. You can see we have a wick all the way up here. So some traders, because we have a wick all the way up here, would actually aim to place the stop loss above this point right here. And in my opinion, none of these stop losses are bad. Both are actually pretty good. And the stop loss you decide to choose here is, pretty dependent on your own trading style. So if you are more of a short-term trader, you might prefer to choose the first stop loss, because if you choose a tighter stop loss, you will be able to also choose tighter targets. While if you use the larger stop loss, the positive thing about the larger stop loss is that it's less likely that you will get stopped out. But at the same time, if you use the wider stop loss, you will need to use a wider target as well. So as you can see here, if you use the first stop loss type, perhaps your target would be down here. But if you use the other stop loss, in order to get a 2-to-1 risk to reward ratio, your target would have to be lower. And when we see large rising wedges like right here, what some traders will also do is that they will measure the length of the wedge. So they take this measurement and then measure from the breakout, right? So these two lines should be the same length, and then they use this right here as their target. But now guys, let's take a look at the symmetrical triangle pattern. And this right here is our first red pattern. And why do I call this a red pattern? Well, for the symmetrical triangle pattern, the direction for the pattern is actually pretty uncertain. And I also, as you can see, I wrote type, continuation, question mark. And that is because in most textbooks, you will find that the symmetrical triangle pattern will be classified as a continuation. So before the pattern appears, you will have an uptrend. And in most textbooks, they will say that this pattern should lead to an uptrend. And if you look at charts, you will be able to find many examples of this being true, but you will probably find even more examples when this pattern turns out to just lead to the price going sideways. And I will talk more about that very soon, but first we just have to know how to identify this pattern. So what we're simply looking out for the symmetrical triangle is that we're looking out for lower highs, and we're also looking out for higher lows. And the important part here about the symmetrical triangle is that the highs and the lows, the slope of these two lines, should be pretty much symmetrical. So now let's take a look at the symmetrical triangle in action. So for this example, I chose a symmetrical triangle that happened after an uptrend. So in textbooks, if the symmetrical triangle appears after an uptrend, it should act as a continuation pattern and continue the price up. But what you will find is that so many times these symmetrical triangles will simply lead to a trading range. A trading range is simply when the price is moving sideways here in a pretty random fashion. And when you look at symmetrical triangles after the fact, it can be easy to think that, this pattern wasn't looking very strong. I would have not taken this trade, and so on and so on. But I want you guys to imagine that the price is right here. So the chart to the right here has not happened yet. And let's imagine that you were a trader that saw this pattern right here. So as you can see, we saw the price beautifully printing lower highs. We saw the price beautifully printing higher lows. And then after the symmetrical triangle, we saw a really nice breakout towards the upside. So when you are at this point in the market, it can be very tempting to buy. But I personally avoid these patterns because so many times this breakout right here will turn out to not be significant, and the breakout will actually be a normal move within a simple trading range. So as you can see, a trading range is simply when we have a resistance area and we have a support area, and the price here moves sideways within this range. And what you will notice is when you look at trading ranges, by the way, the price action inside the range tend to be pretty random. When you look at trading ranges, a very common mistake, especially for beginners, is that they try to find patterns, in everything. For example, some trader might notice this right here, right? So this part right here as some sort of triangle. They might find, just this part right here as some sort of triangle, and perhaps they might find, another symmetrical triangle right here, and so on and so on. So these sort of symmetrical triangles can very easily fool, especially beginner traders, and that is another reason why I actually think that it's best to avoid these type of patterns. And now, while we are at it, let's take a look at yet another red pattern. This one is the broadening range pattern. And as you can see, for this pattern, I actually have both the direction uncertain and also the type uncertain. So one could actually argue that this one is even worse than the symmetrical triangle. Or in other words, this pattern is super hard to trade. But that is actually one big reason why this pattern is so important to identify. As a trader, it's important to identify the patterns you want to trade, but it's also important to be able to identify patterns you don't want to trade. So how do we find the broadening range? Well, what we're looking out for here is that we're looking out for higher highs. So we want the price to print higher highs, but we also want the price to print lower lows. So we want to see an upward sloping resistance line while at the same time seeing a downward sloping support line. And what this pattern basically tells us is that we are seeing increased volatility. In very simple terms, volatility is how much the price is moving around the average. So if we have, a price that moves something like this, moves very close to the average, this right here is low volatility. But if we have a price that moves, a lot around the average, this right here is high volatility. And what the broadening range basically tells us about the price is that the volatility is increasing. So here we have a real life example of the broadening range. As you can see, we have both. We have highs here and we are printing consecutive higher highs, while at the same time we're printing consecutive lower lows. So what this basically means is that the volatility is increasing during this time period. But just as with the symmetrical triangle, these broadening ranges will often turn out to just lead to the price going sideways in pretty much a range fashion. So as you can see, this broadening range turned out to pretty much be, a sort of trading range where we have a support and resistance and the price going sideways. So my general recommendation here is to avoid these patterns. But if you want a trading strategy, one thing you can try to do, but once again, I actually don't recommend doing this, is to try to find movements quickly above the resistance or quickly below the support, and then try to enter at the failed breakout. So for example, here is an example. The price tried to push above the resistance. We failed here. So one possible entry is to try to enter here at the reaction of the resistance, placing your stop loss above the resistance, and then using a risk to reward ratio such as 2. So your trade could have looked something like this. But these type of trades are super hard, especially when you are actually in the live markets. When you look at past examples, you will always be able to find many good trades, but when you are in the heat of the moment, it will be much harder. So now guys, let's take a look at the cup and handle pattern. This pattern is typically a bullish continuation pattern, but in some cases, it can also act as a reversal. And as you guys can see, this right here is a very large pattern. It's probably the largest continuation pattern out there. And this one is more for advanced traders because it can be quite hard to spot. But what we're essentially looking out for here is that before the pattern appears, we want to see a trend towards the upside. After this, the price starts to print both lower highs and lower lows. So we are sort of starting to see the beginning here of a downtrend. But after a while, we start to see higher lows. And within the cup and handle pattern, we often see another pattern, and this is actually a reversal pattern. If you want to, as an exercise, drop down in the comments below what type of pattern we have right here. Pause the video right now if you want to. Well, this pattern right here within the cup and handle is actually a head and shoulders, and this, as you know, is a reversal pattern. So within this large cup and handle pattern, we will often have a sort of small reversal pattern within the pattern itself. So this is a little bit complicated, but essentially what we're looking out for here is that we see the beginning of a downtrend, but then the price start to reverse. And what we want to see here is a sort of U shape. So the price goes like this in a U shape, and then we see a pullback like this. After this pullback, the goal of the pattern is to continue the price towards the upside. And what we want to do here is that we want to connect the highest point of the first move up, and we want to drag a horizontal line like this. And the reason this is called a cup and handle pattern is because this right here, the U shape, pretty much looks like a cup, and then the pullback right here pretty much looks like a handle. So this is where the cup and handle name comes from. And as I said, after the handle, the price breaks higher. So now let's take a look at the cup and handle strategy. And when you look at this market right here, you can hopefully see that in the heat of the moment, these patterns can be very hard to spot. But what we see here, we see all the things we need for a cup and handle. Before the pattern appears, we saw a strong move towards the upside. We can even notice here that we saw a gap. You can see we saw a massive gap in between this point and this point. A gap is when the price is trading up when the market is closed. So this is something you can see, for example, in the stock market when you have trading hours and you have hours where the stock market is closed, such as weekends or overnight. So these kind of gaps, like we see right here, can be created, for example, during the weekend. But as you can see, we had this move up here, and then we saw a lower low, lower low, higher low, higher low, higher low. So you can see that we sort of have the U shape we talked about recently. And if you pay really close attention here, as we talked about, we can often sort of find minor head and shoulders looking patterns within this pattern. So this is far from perfect, and this is not a valid head and shoulders, because remember, an inverse head and shoulder should come after a downtrend. But what you can notice here is that we can pretty much see an inverse head and shoulders here, because we have a low, lower low, higher low. We can drag a sort of neckline like this, and hopefully you can see how this is similar to an inverse head and shoulders. In this example, the handle of the pattern is this move right here. So it was a smaller handle compared to most textbooks, but the price eventually broke above and continued towards the upside. So there are multiple ways to enter the cup and handle. The first entry point is to enter the break of the horizontal line. So to enter at this breakout candle right here. So in this case, your entry would be at the candle close of the breakout candle. As for your stop loss, you usually want to place it below the low of the handle. So this right here is the low of the handle, and using a risk to reward ratio of 2, your target would maybe be up here. Another possible entry point is to enter at the retest of the resistance. So here we have resistance, we tapped one time, we saw resistance once again, the price broke above, and then we tested previous resistance as support. And here you don't want to enter blindly at the support. What you want to see is that you want to see a reaction, and preferably a strong reaction. So the entry on the retest here would be after this strong candle right here. One good thing about this entry is that you can have a pretty tight stop loss, because you can place the stop loss below the lowest point of the retest. So you can set the stop loss right around there. And as you know, setting a tight stop loss can allow for a tighter reward. So you could set your reward around here using a risk to reward ratio of 2. Another potential entry is to enter at the handle itself. So enter at this pullback right here. And for this handle, we actually have 2 entries. So we have so many different entry strategies for the cup and handle. So you can either enter the breakout right here, or you can try to enter the support of the handle. So for example, enter right here. In this case, because the handle was so small and not very clear, this is an entry I would personally avoid. But if you have, let me show you guys, if we have a more clear handle, so if we have a handle that maybe looks something like this, it's possible to get more clear entry points from the handle. And a good thing about this type of entry is that we enter at lower prices, and we can also get some pretty clear stop loss levels and target levels from that entry. And as with many chart patterns, another way to take targets is to measure the pattern. So we measure from the low up to the point, then we take this measurement, measure from the breakout, and this is another thing you can use to determine your target level for the cup and handle. And now guys, let's also take a look at the reverse cup and handle here real quick. This one is the bearish version of the cup and handle. So the direction is bearish and the type is most often continuations. Sometimes it can also act as a reversal. And in my opinion, the reverse cup and handle can often be even harder to spot than the normal cup and handle. So this one needs a little bit of practice. But this pattern is basically the same but the opposite as the normal cup and handle. So what we're looking out for is this U shape. So we're looking out for a U shape right here. Then we're looking out for the handle here. And the goal of the pattern is to continue the price towards the downside. What we also do for the inverse cup and handle is that we drag a line here between the lowest point of the first move down and between the highest point of the U shape. So here is a real life example of the reverse cup and handle. And here I actually shows an example where we have a much larger handle. So remember, from the normal cup and handle, we had a very, very tiny handle. But in this case, you can see that the handle itself was a very large pattern. And if you look really closely at this pattern, you will notice that this is another chart pattern. If you guys want to, let me know down in the comments what type of pattern we're seeing as the handle right here. So pause the video right now and answer the question if you want to. But let's take a look here. So as you can see, in this case, we had a very nice U shape. So the cup part of the handle was very, very clean in this case. And then during the handle itself, we printed higher highs, but we also printed higher lows. But what we can notice here is that the range is getting tighter and tighter. So this right here is a rising wedge, which in itself is a bearish continuation pattern, meaning that the goal of the handle itself is to continue the price down. So in this case, we can enter the reverse cup and handle as a rising wedge. So we can enter here as the price is breaking the rising wedge. So the entry is at the candle close of the breakout candle. Since we do have a high just slightly above the previous high right here, you can see this black line, I would actually place, for this case, I would place the stop loss just above this point. And using a 2-to-1 target, our target level would be right around here. Another strategy is of course to enter the break below support. So we have support right here and right here. And our buy signal would be at the candle close of this breakdown. For this entry, you could set your stop loss just as we did with the other entry strategy, so all the way up here. However, the downside with this type of stop loss is that your target level has to be so far down. So what you can try to do here is to place your stop loss somewhere above the broken support, right? If you want a much tighter stop loss. However, since the price was moving down in a straight line here, we don't really have any clear highs where we can place our stop loss above. So for this breakout right here, the stop loss placement would actually be very tricky. You could try to place it somewhere around here, but this is far from a perfect stop in my opinion. However, the upside with this type of stop placement is that your target can also be relatively tight. So now it's time for the ascending triangle pattern. And in my opinion, this right here is one of the best chart patterns out there. This pattern is a bullish continuation pattern. So before the pattern appears, we need to see an uptrend. And after the pattern, we see the price continue towards the upside. The most important part about the ascending triangle is that during the pattern, we need to print consecutive higher lows. And this is very important. And what we also want to see here is that we want to see the highs of the pattern to be around the same level. These highs doesn't have to be exactly at the same level, but they should be around the same level. And what we do here is that we draw an upward sloping line connecting the lows, and we draw a horizontal line connecting the highs. The first pullback after the break of the resistance is also an important point, and I will talk about that very soon. So now let's take a look at the ascending triangle strategy. Here we have a great real-life example of an ascending triangle. You can see that before the triangle appears here, we have an uptrend. Then we saw the price clearly printing consecutive higher lows. And we also saw highs here coming in at pretty much the exact same level. The most common entry point here is to enter at the break above resistance. And as with pretty much all breakout entries, what we're looking out for is that the candle that breaks out, we want to be strong. We want the real body of the candle to be larger compared to the real bodies of the candle inside the triangle. So we buy at the candle close of the breakout candle. The stop loss here is pretty straightforward. We want to set the stop just below the most recent low inside the triangle. So we want to set the stop loss just below that line. Here we can once again use a risk to reward ratio of 1 to 2. So our target would be right around here. With that said, not all breakouts will be perfect like this example. You can see right here, the price broke above and it never looked back. But many times you will see that we will have a breakout and then after a while the price will be pulling back. So another way to enter the ascending triangle is to enter at the pullback after the breakout. And here you can either enter at the break of the pullback, so you can enter at the breakout, or you can enter at the support of the pullback following the break of the triangle. Next up, we have the descending triangle. This right here is a bearish continuation. So before the pattern, we have a downtrend. The goal of the pattern is to continue the price towards the downside. And for the same reason that I love the ascending triangle, the descending triangle is, in my opinion, one of the best. But as you can see, for this example, what I want to show you guys is that the most important thing is that in order to identify this pattern, we need to see lower highs. But as you can see, in this case, I on purpose made the lows here, not at the exact same level, but we want the lows to be at around the same level. So some lows can go dip a little bit below support, some lows can be a little bit higher. But what should be really clear when you identify these patterns is that the triangle should clearly be sloping down. So here we have a real life example of a descending triangle. You can see the price goes down before the pattern appears, and then we can clearly identify lower highs, and we can also identify lows here happening at the around same level. And for the ascending triangle, we have already been talking about that you can enter here at the break of support, so you can enter right here. But for this example, I want to focus on the other type of entry, and that is the entry point that is already marked here. You can see this red point right here. Because as I talked about on the previous pattern, not all breakouts will be perfect and lead to the price just falling like a knife. Sometimes we will see a pullback after the breakout. So you can see in this example, we had a clear pullback here after the breakout. So the price broke, but then the price started to move up here. And this is another excellent entry point, and you can enter on different ways here on the pullback. The first entry is that you can enter on the reaction of previous support flipping to become resistance. So in this case, you can see we had the support here, 1 and 2, also a small touch here. So we had 3 pretty clear touches. The price broke below, but in this particular case, we tested that exact previous support as resistance. So here you can enter at that reaction, and I would not buy here until we see a strong reaction. So I would wait for this first strong bearish candle before I enter the trade. For this entry, we have a super clear stop loss. We place the stop loss above the resistance that came from the previous support, so we can place the stop loss just there. And this allows us for a pretty tight target level. So using a risk to reward of around 2 to 1, your target would be somewhere around here. And you can see that we reached the target level pretty quickly. You can also enter here at the break of the pullback structure, so you can enter around here. Once again, the most clear stop placement is to place it above the high. But as you can see in this case, because we have a wider stop, in order to get our 2 to 1 risk to reward, our target level would have to be placed pretty far down. But for the descending triangle, you can of course enter at the breakout. So this right here is probably the most common entry to enter at the break of the pattern. The entry and stop loss is very similar to the ascending triangle. We enter here at the breakout. Stop loss is placed above the most recent high. Target level either 2 to 1, or what you can also do here, and that you can do for the ascending triangle as well, some traders will measure the pattern, take this measurement, measure from the breakout, and place their target level based on the measured move. But yeah guys, this course is actually coming to an end now, and I want to thank you all so much for watching. If you guys made it through all the way to the end, you are a beast. If you want to, you can drop a comment down below and write something like "made it till the end." But yeah guys, if you want to support the channel, as you guys might know, I don't have any sponsors or anything like that. So the best thing you can do to support is to smash up the likes on the video, and if you want to, share the video with someone you think would benefit. And also guys, of course, don't be afraid to drop a comment if you have any questions about anything in this video. I will try my very best to answer every single comment. And also guys, if you want to continue your learning journey, I highly recommend watching my playlist that you can see on the screen right here. This is basically a playlist with all trading courses I have made so far. I hope to see you in the next one. Take care. Ciao, ciao.